Good afternoon. I'm Chris Swift. On behalf of my partner, Chris Wimward, and our sales assistant, Sean Gammon, thank you for joining us on this 2024 outlook for the cattle cycle. So I've used this diagram of the hourglass to represent what I think that the industry looks like. By designating each one of these sectors there, it helps them to be able to see each one of the sectors and where they may be involved in what we currently believe is a new agenda that's being formed in the cattle market and beef production. So believing that it starts with the center of the plate, the consumer out there, let's take a look at the consumer right now and kind of see what's going on. They have believed to have been shifted greatly in their discretionary spending habits. These changes have now been seen in a little bit lower box prices. We've seen it in some of the consumer product price index, the producer price index, and we've also seen the Fed begin to soften just a little bit in their rate increase hikes. So this change is going to be something that's going to be needed now in the consumer, where they have shifted to a lesser discretionary spending habit. So the key to this is getting that inflation under control, keeping jobs elevated where the consumer has the money to be able to purchase the goods. And then we kind of see what takes place somewhere down the line, middle of the year, closer to what we think the next election will be, and a change in our leadership. So the consumer right now is believed pretty much set in their discretionary spending habits, unless something really dramatic now takes place within the economy. So then we go up to our grocery stores and restaurants, and this is where we think we're seeing some really big issues there, and that being that they've lost their margin. Grocery stores work off of very low margins, as well as do restaurants in some cases. We've just recently, within the last couple of months, noted that we are increasing our imports from other countries, and we have to understand why we're doing this. It is because these companies have lost their margin to it, and they need to be able to find it. They need to find some way to either lower the cost of inputs to it, or they need to be able to raise their prices. And in this instance, we've seen both. We've seen the prices rise at the restaurants, we've seen the prices rise at the grocery store, and we've seen lower consumer demand because of that. So in the aspect of it there, from the slaughter, from the packer participation, from the grocery store, all the way to the restaurants there, these are trying to attempt to find margin. So that's what we're going to be looking for on the back for the issues of the grocery stores and the restaurants, is them seeking margin. And that is one of the reasons why we believe they are out there buying this imported meat, is because it's cheaper than U.S. meat, in order for them to be able to increase their profit margin. So then we look at the packers and processors, and this was where we think that they have come in to play, trying to find margin for them. What they've done is they've cut the slaughter pace, and it is very unlikely that they will increase that slaughter pace to be able to facilitate the size slaughter needed to keep cattle from backing up. And I think that's their goal: back cattle up, increase the weight per cow, as well as increase the number of dairy and beef slaughter, beef mixes on there, and to imported meat. And that imported meat helps to blend into U.S. meat, lower the price of it, which helps go sell that meat to the producer, into the grocery store, restaurant, and then on to our consumers. So let's take a look at the cattle industry now, because this is where we think that the agenda is going to have the most impact. And it's probably the feed yard that we see right now going to either have to make some significant changes in production, or we're going to have to see some declines in the cattle feeding pen space out there. So the first aspect of the agenda is, again, the consumer. The consumer was wrought with inflation. They had to lower their spending habits in order to be able to afford the things that they needed. The grocery stores lost margin because the high beef prices came in, and consumers at the same time started pulling back. They raised prices for their goods, and then that also began to impact the demand. Packers and processors are now slowing the slaughter pace down, going to build more beef on those cattle, and that takes us to the feed yard. The feed yard paid the top price for feeder cattle in September of this year via the index at $254.10. We believe that those cattle, the majority of those cattle that were purchased at that price level, will be slaughtered sometime in February. In January, there is a great need to rebuild the cattle herd. And this is what we see right here. This is the weekly marketings of feeders and stocker cattle. And as you can see, the month of January is second only to the month of July in the number of marketings. I understand that not all of these cattle go on feed, but a great number of them are. And if we see this particular aspect where we are keeping up with the previous years of placements, then there's no reason to think that, January placements will be down anything dramatic. They may be, but it's probably not going to be by too awful much. We know we placed more cattle in October. We're probably going to place a pretty good amount in November, even if it's not 100%. And then we do begin to dwindle as we go down to the other parts of the year there. So I'm going to back up just a little bit and show you, go back to here on our chart. And this will now take us to the feeder cattle index. We've seen a drop in the feeder cattle index, what we believe to be the wave 4. This wave 4 was just feeder cattle prices way too high, and the cattle feeder projecting enormous losses, and in some cases, maybe historical losses per head. If we think about the timeline that we have now spent, the agenda was noticed sometime in September, October of this year, leading me to believe that the agenda was most likely began about this time last year. We moved forward into May when we made the first deal with the imports of fresh beef from Paraguay, and then we found that out in September, October. Again, we're starting to now, as well as we saw the increase in carcass weights and began to project them even higher. Now the agenda is being recognized. We're going to have more beef per cattle. So in this timeline, I felt like we could pull back into the 220 range right in here, and we've already exceeded that. If we think about how the market should unfold in a corrective manner, it should have 3 waves. This move down is just the A wave. If we look over here to our next chart and we kind of foresee what might happen in the future, our anticipation is a large B wave rally that could last sometime into the summer. So my thought process is cattle feeders needing to reload sometime in the January, February timeframe, bring a lot of cattle into the feed yard. As we move into the March, April, May timeframes where there may be a lot of desire for cattle, tremendous amount of wheat pasture cattle go off of wheat. Maybe they go on to grass for a while. Maybe you just start seeing grass cattle show up and the prices begin to increase because spring has a tendency to bring out a desirable time frame to want to buy cattle. Then we move into the summer of the year where we're going to see those big video sales, where we sell the bulk of our inventory in June, July, and August. Maybe by the time we get there, the agenda, still very much in place, is taking hold very well. And it looks like there's not going to be as much expansion to take place in the year of 24 as what we think there could be, because the prices just aren't there or are low enough for the cow-calf operator to reload and to begin to say, now we can really start to expand. I've read in a couple of publications that the pastures need some time to heal before they can come back and really hold or sustain a bigger cow herd onto them, as well as I think that we're going to probably do a lot more in our regulations this year in the year of 24 that might continually lower the number of animals per acre that we have on. Something that's going to do with that greenhouse gas emissions, the CO2 effect. There was probably going to be more regulation to that. Carry on. We're into the summer months now, and we just don't see the same demand consumer-wise. We are increasing our supplies instead of decreasing them, and we make the C wave of the wave 4. Something that's going to even confuse people more, as we thought that the rally in 23 could never end. It did, and now we're saying that it might not even end there. some of my aspect to it psychologically is when we were in 2014 at the top, no increase in cattle had been seen that were market ready available. The market broke $50 in anticipation of those cattle coming, but the cattle weren't there, and the market rallied $30 back. By the time it rallied to $30 back, 8-9 months had gone by, and those cattle started coming, and we plummeted and we stayed down there. If we think about this year, the agenda was recognized in September, October. It's now beginning to take an impact to it. Maybe there's some waivers in that agenda in the springtime where cattlemen decide they want to be bullish again, bid the price up, but the overwhelming fundamentals of just enough beef to satisfy the consumer at these price levels drives cattle prices back down, because who needs margin now? The cattle industry needs the margin now, and that's where it can't be found anywhere. So cattle feeders are going to have to do something. They're going to have to lower pen space in order to make feeder cattle prices lower. They're going to have to really jump in and buy a lot of feeder cattle, because there's not going to be nearly as much of them when we get into the March, April timeframe of this year. So there's some variations that just aren't going to be probably set in the year of 2024, making the year of 2025 appear the one where we may see the big rally. We've completed a major wave 4. This agenda has now taken place that gets us through a brand new administration, where that new administration to come in and stimulate the economy instead of burdening it. There's no telling what prices might go to. But when we look at that, that's something that I like to do. I like to try to foresee what the market may do. And then if it doesn't, the prices don't start following along, kind of similar to what I think, I know I'm wrong. And it helps me to change that analysis much quicker. If it starts to work as is, that analysis is correct, and the decisions we make based upon that should help significantly. So again, we go back to the weekly marketings here that we know. We know that we market the majority of cattle in July and June and July, and those are primarily the big, large video sales. January is our second to it that we do. We go back now to this, and this is where we look at the feed yard closeouts as being very detrimental. If you look at that 2020 low, that is approximately $280, and that was caused with the Holcomb County fire that took place. They couldn't get cattle killed. They backed up immensely, very quickly, dropped the losses, immensely, and then notice they rebounded right back up again. But if you look at that, the top red line right there is zero. How much trading has taken place at under zero versus above? And then look at this huge spike up and right back down again. The likelihood of stopping right here is not very good, because we already know what the projected losses are going into February for those feeder cattle that were paid above $250 for. And remember, that was just the 850-pound steer. There was some 800-pound steers that probably went 260, 270 in some cases. So again, the losses are going to be staggering as we go forward. Backgrounders will probably have the toughest row to hoe this year, because there's no more premium in the futures market. All of this summer, it doesn't matter how much you didn't make. Everybody made the basis spread. It didn't matter whether you hedged the market, you didn't hedge the market. The premiums of the futures offered so much, and the market went up so much, it's highly unlikely that anyone lost money. They may not have made as much as some did, but very few of them lost money. It's not until we see September where we paid the highest prices, and now things have plummeted. So like the feed yard sector industry with fewer cattle, there's probably going to be too much backgrounding operation too. If we think about the timeline, one, we've not started expansion. We've not even stopped liquidation. If it's 5 or 6 more months into the spring of next year before we start expansion, then another 1.5 years before that first calf is ready. We're talking 2 to 3 to 4 years out before anything, knowing that we've got excessive amounts of production capabilities for cattle. We're fixing to lower the cattle herd significantly going forward, especially in 2024. if you do in 25, if you do see some expansion and the kills stay elevated, then we stay right about where we are. And then in 25, if expansion really takes off, now we pull the heifers out and we will really be short of cattle then. Let's take one more look here at our hourglass. And again, we use this example here to show what the sectors are. And let me tell you this little area right in here, the throat of the hourglass is really important. I think that if you think about a damper on a pipe, stove pipe, both sides have a key to it. The packer has a side and the feed yard has a side. The packer right now has only got it about halfway open. The feed yard side has theirs all the way open. Right now, we have more cattle than we do not necessarily packing capacity, but capacity that wants to be utilized right now. So we probably got more cattle than that. That keeps the damper halfway closed to the packer, keeps it wide open to the feed yard. So our last is going to be the cow-calf operations, and this is where the forefront of this issue is. I don't believe they're going to expand anytime soon. I continue to hear lack of labor, the really high cost of everything. Today, I read an article that stated the state of Tennessee has lost 86,000 acres of farmland due to development, housing, home development. That's happening a lot in the Southeast, and the Southeast is not a large cattle producer as a whole, but when you put us all together, we make up a huge percentage of the total number of cattle produced, especially in the small states of Georgia, Tennessee, Kentucky, North Carolina, South Carolina, and the Virginias. All of those areas are big cow-calf areas because the land there is not very good for tillable row crops. So we got really expensive land. We got land going out of production. It's worth a whole lot more out of production. Regulatory issues are going to continue. So to really expect the cow-calf operator to expand as the cost of everything is elevated, it's just not very good. They'll try and they'll want to, but I'm just not real sure that the financial aspect of it is there just yet. If it is, it's going to be a very large investment for a very high-risk trade a year from now. We start the year of 2024 raising a lot of cattle for the year of 25, start pulling them out. Prices of calves could soar and not see feeder cattle or fat cattle prices soar because those sectors are still filled with cattle right now. And the fewer cattle that you have with them, the more space they're going to have and the more likely it is they are to contract. So we've got a great number of issues that we're going to have to deal with this year. And I think that if we take it from the aspect of the Elliott wave, stating that the psychology of the producer right now is very weak due to the agenda, he comes in sometime through the first of the year and begins to rebuild that attitude of there's no more cattle, we're not doing anything, the consumer improves. Whatever the case may be that pushes cattle prices a little bit higher, I think the agenda from the consumer, the grocery stores, and the packers will continue to produce enough beef that may keep beef prices from soaring higher and therefore may not be able to maintain or sustain the higher cattle price. Then we see another decline sometime starting in the summer of 24 and lasting all the way to about this time next year. After that, I think 25 is going to be a pretty good year. Know that as we move into this, a couple of questions that are more important to ask, I think, than the actions being taken, because once doors are open, it's very difficult to close them. Now that we have fresh beef coming in from Paraguay, it's going to be much easier to open that door to others than it will be to close this door. Why were those doors open? It was because the margins were declining in our grocery stores and restaurants and our packer processors. And in order to find margin, they went seeking cheaper inventory, cheaper products out there, and that undercuts you. You need to find out who these people are, what made them do that, and then try to meet their need. That's what business is all about, not your cattle going straight up. It's what need are your cattle satisfying? And that's where you're seeing the issue come in. We're going more and more to imported beef because we're not meeting the needs of those that market beef, either through restaurant, groceries, or in a packer. So again, that's my aspect of it. 2024, probably not going to be a stellar year. I think if we can get prices up this spring, it's going to offer an opportunity to hedge some of our feeder cattle prices and maybe some of our fat cattle prices going into the late summer and fall of the year. And then after that, we'll just have to see how things go before we make too many projections on 2025. So I appreciate you taking the time. If you got any comments on some of the things that I've said, if I've misspoken anywhere, please feel free to correct me on there or add to. I'm always appreciative of any kind of information that's not derogatory, and I can handle that too. But we want to try to find out what the answers are, not beat one another up over why we think cattle price should be higher or lower. I'm Chris Swift. Thank you for taking the time to listen. Hope you have a great and wonderful holiday.